Market Recap. I'm Daniel.
And I'm Mira.
So, the stock market just closed at an all-time high today for the fifth consecutive day, actually.
Right, which is just incredible momentum.
It's wild. But if you look over at the bond market, the 10-year Treasury is basically sitting there flashing this giant red warning sign about sustained high inflation.
Yeah, totally different story over there.
Exactly. Which begs the question, is Wall Street just completely ignoring reality? Or do equity investors see a runway that the rest of the financial world is just missing? So welcome to the deep dive. Today we are breaking down the April 16th, 2026 market session.
And what makes this deep dive so critical is that making sense of this exact divergence between what the macroeconomic data says and what the stock market actually does, that's how you understand the real financial landscape right now.
Right.
And we aren't here to endorse the market's view or, tell you what to think. We're just here to give you the fundamental logic behind today's massive moves so you understand the baseline you are operating against.
Yeah, and before we jump in, we just need to explicitly state that this show is for market context and discussion only. It is not personal investment advice or an investment recommendation.
So, set the stage for April 16th. The overarching narrative is really one of just stubborn, almost defiant optimism in equities. Like you mentioned, both the S&P 500 and the NASDAQ closed at fresh all-time highs again today.
5 days in a row of breaking records, which is crazy when you consider the broader backdrop we're swimming in. I mean, we have the VIX, the volatility index, actually ticking up slightly today to 18.26.
Showing that institutional anxiety is bubbling just under the surface.
Exactly. And meanwhile, the 10-year Treasury yield is holding incredibly firm around 4.26%. You rarely see equities throwing a massive party at all-time highs when the bond market is essentially shouting that interest rates are going to stay elevated for the foreseeable future.
It creates a really fascinating tension. I mean, equity markets are clearly pressing in a scenario the bond markets remain highly skeptical of.
Right. So to understand why the market is brushing off those warnings, we have to trace the momentum back to where the day actually started. Which brings us to our first session. What set the stage before the U.S. session?
Well, the foundation for today's rally actually poured in overnight out of Asia. At 10 a.m. China Standard Time, which was 10 p.m. Eastern Time on April 15th, China reported their first quarter economic growth.
Okay.
And it came in at a very solid 5.02%.
Right on the nose of their official targets. But why does that specifically matter to, say, a tech investor in New York or a manufacturer in Ohio?
Because from a global macroeconomic perspective, China acting as a reliable growth engine eases the absolute most terrifying scenario for markets, which is a synchronized global slowdown.
Oh, right.
When the world's second largest economy proves it can still generate solid 5% growth, it supports the thesis that international demand is resilient. It tells the market that the global supply chain can actually withstand the tighter monetary conditions we're seeing in the West.
Yeah, and the reaction was immediate. I mean, this was a massive risk-on catalyst right out of the gate. If you were watching international charts, you saw Asian equities just catch a huge bid. The Nikkei in Japan and the Kospi in South Korea both jumped by over 2%.
Wow.
It essentially built this concrete floor of optimism for global markets before European or U.S. traders even woke up.
Right. But as the sun rose over Europe, the global policy narrative splintered a bit. Around 9 a.m. Central European Time, so that's 3 a.m. Eastern Time, we got a major signal from the European Central Bank.
The ECB.
Yeah. ECB policymaker Matus Miller explicitly noted that their upcoming April 30th meeting might actually be too soon to decide on an interest rate hike.
And his reasoning was heavily tied to the physical economy, right? Specifically, falling energy prices across Europe.
Exactly.
Yeah.
Which creates a textbook divergence in central bank policy.
Yeah.
Because in the U.S., we're battling sticky structural inflation driven by services and wages. But if Europe is seeing energy prices fall significantly enough to make the ECB hesitate on hiking rates,
we're looking at a fracture in global yields.
right. Capital always seeks the best return for the lowest risk. If European yields stall while U.S. yields stay high, money moves across the globe incredibly fast.
And that shift in the global yield differential boosted risk appetite even further. It also created a fascinating mechanical play in precious metals. Gold caught a 0.80% haven bump, pushing it up to $4,838.50 an ounce.
Yeah.
Investors use gold as a play on that exact currency and yield divergence, hedging against the volatility of central banks moving at completely different speeds.
So we have Chinese growth providing the demand floor and a potentially dovish ECB providing a liquidity cushion.
Yeah.
But then we have to factor in the geopolitical chessboard.
Always a wild card.
Definitely. At 4 a.m. Eastern Time, the overnight news wires lit up with a serious reality check out of Pakistan. They formally announced that absolutely no dates have been set yet for a second round of U.S.-Iran peace talks.
Which is a jarring contrast to the narrative we saw just yesterday. During the prior session, remember, we had a massive cross-asset rotation when President Trump announced that talks could resume soon.
Right.
The market rapidly priced in an almost immediate easing of tensions in the Middle East.
And a delay in those talks theoretically implies a renewed risk of physical escalation. I mean, textbook models assume a breakdown or delay in diplomacy immediately raises the risk premium on global assets.
And this is exactly where I have to push back on how automated academic models digest these events.
Okay, how so?
Algorithmic trading bots treat geopolitics like a random weather event, like a thunderstorm you just can't predict. They see the words talks delayed on a wire, and their programming dictates they must dump stocks to price in a risk shock.
Well, because the models demand an immediate mathematical adjustment to the probability of oil supply disruptions, right? Like the Strait of Hormuz.
Right. But geopolitics isn't a random thunderstorm. It is sequential human game theory. A delay announced by a broker like Pakistan isn't necessarily a collapse of diplomacy. It's a calculated poker move by rational actors sitting at a table.
A negotiation tactic.
Exactly. It's posturing. And what's vital for you, the listener, to understand today is that human investors seem to realize that. If you're watching your portfolio, this is why you didn't see a massive geopolitical sell-off this morning.
Right.
Investors who can read the geopolitical game actually have a distinct edge over the algorithms here. They didn't panic. They understood the developing logic of the political board, which allowed U.S. equities to sustain their upward drift without even flinching at that Pakistani wire.
That is a crucial distinction between algorithmic binary logic and human contextual logic. I'll give you that. The bots look for deal or no deal, while human participants understand the necessary friction of diplomatic negotiation.
Yep.
So wrapping up the overnight picture, we had strong Asian growth metrics, diverging signals from European central bankers, and a geopolitical environment that, while delayed, isn't collapsing. It laid out a highly resilient, optimistic runway.
A perfect runway, but as we know, the U.S. economic reality was waiting on the tarmac to test it.
Let's take a quick break to grab a coffee, and when we come back, we'll dive into the U.S. Open.
Sounds good.
Welcome back. Which brings us seamlessly into our second session. What moved markets during U.S. trading hours?
Well, the U.S. session was essentially defined by a massive, high-stakes tug-of-war in the macroeconomic data. We received a morning data dump that sent completely conflicting signals about the physical state of the American economy.
Yeah, let's anchor the facts so we can see the conflict clearly. At 8:30 a.m. Eastern Time, initial jobless claims dropped to 207,000.
Which is incredibly low.
Very low, well below forecasts. Now, continuing claims did jump slightly to 1.818 million, but that initial drop shows companies are hoarding their workers. They are terrified of letting talent go.
At the exact same moment, the Philadelphia Fed Manufacturing Index unexpectedly spiked to 26.7. That isn't just a slight beat. That is a massive surge, indicating regional factory floors are firing on all cylinders. But then...
There's always a but.
Always. Just 45 minutes later at 9:15 a.m. Eastern Time, the broader U.S. industrial production number fell 0.5% for March.
And synthesizing those 3 points requires looking at the broader structural forces at play. Because a tight labor market combined with localized manufacturing surges strongly reinforces the no-landing scenario.
Right?
The U.S. economy isn't going through a hard recessionary landing, nor is it going through a soft managed landing. It's just continuing to fly at high altitude. And we have to look at the engine fueling this aircraft.
The stimulus.
Exactly. It's a combination of massive deficit spending from the One Big Beautiful Bill Act, the OBBBA stimulus, and the $635 billion artificial intelligence capital expenditure supercycle.
Let's unpack that OBBA stimulus for a second, specifically the 100% bonus depreciation provision, because I really think that is the secret sauce here. What does that actually do to corporate behavior on the ground?
It acts as a massive behavioral lever for corporate accounting. Normally, if a major tech company builds $1 billion AI data center, they have to spread that tax deduction out over many years.
Right, depreciation.
But with 100% bonus depreciation, they can write off that entire capital expenditure in year one, It effectively hands corporations a giant immediate discount for building physical infrastructure today.
Which means this massive AI build-out is entirely acyclic. These hyperscalers don't care if broader consumer demand is softening or if industrial production dips by 0.5%.
No, not at all.
They're locked in an arms race to build AI server farms, and that localized spending just keeps violently pulling the broader economy forward.
But the shadow side of a no-landing economy is that inflation also refuses to land. And the Federal Reserve made a highly coordinated effort to remind the market of that reality today.
They definitely did.
Yeah, at 9:30 a.m. Eastern Time, New York Fed President John Williams explicitly stated that the Fed is well positioned to maintain their current 3.5 to 3.75% target rate. He pointed directly to these elevated inflation readings. Then at 11 a.m. Eastern, San Francisco Fed Vice President Adam Shapiro published a stark warning detailing how oil market volatility and supply disruptions are actively threatening the Fed's 2% inflation goal.
And this is where we hit a glaring, almost absurd contradiction in the market today. Look at the physical reality. The 10-year Treasury is anchored at 4.26%. The Federal Reserve is officially, out loud, on the record, telling everyone they are not cutting rates anytime soon.
Right.
The structural inflation fears are mathematically sound, yet the stock market just closed at an all-time high for the 5th day in a row. It is still coasting on yesterday's AI euphoria, fueled by the ASML earnings beat. What we are witnessing today is what I call the illusion of instant information diffusion.
Meaning the market hasn't actually absorbed the gravity of John Williams' interest rate comments.
Not even close. I mean, textbook models assume that the moment a Fed president speaks at 9:30 a.m., every asset in the world instantly recalculates its exact present value based on a higher discount rate.
Sure.
But human traders aren't calculators. They possess bounded rationality. They can only process so much complex information at once. So rather than doing the hard, painful math on how 4.26% bond yields compress future earnings, they cling to the easy, emotionally satisfying narrative. Tech is booming.
Right, the AI hype.
Yeah, they see the hyperscaler spending billions, and it delays the true price discovery of a higher for longer interest rate environment.
I hear what you were saying about bounded rationality, and, well, you make a fair point about human processing limits. While academic discount models do assume instant mathematical pricing of new interest rate realities, the physical practice of price discovery does take time.
Exactly.
The equity market is clearly riding the emotional high of tech earnings resilience right now, essentially choosing to ignore the bond market's warnings, at least for today.
And it's also choosing to ignore physical reality in the commodity space. Look at the energy markets midday today. At 12 p.m. Eastern Time, a major development occurred in the Middle East. A second U.S.-sanctioned supertanker deliberately entered the Persian Gulf, openly defying the blockades.
Wow.
Now, we discussed the geopolitical game theory of delayed peace talks earlier, but the physical bottlenecks, the naval mines deployed during the February escalations, they are still physically in the water. The geographical choke point is still choked. Yet WTI crude oil still fell 2.55% today, closing down at $88.96 a barrel.
That is the market trading heavily on the anticipation of diplomatic resolution, rather than the physical reality of delayed maritime logistics.
Right.
The risk premium is deflating because the worst-case scenario seems incrementally less likely, even if the current logistical situation remains heavily constrained.
It's a market pricing in hope over hardware. So to summarize U.S. trading hours, today was defined by an incredible macroeconomic tug-of-war. We had red-hot regional labor and manufacturing data colliding with hawkish Fed speak, while a resilient, almost stubbornly optimistic bull market in equities pulled completely in its own direction.
Yeah.
Let's take a quick break, and when we return, we'll unpack the corporate side. Moving
from the broader macro tug-of-war, we have to look at how these forces impacted specific companies. Which brings us to our final session, corporate events recap and what to watch next.
Let's zoom in on the healthcare sector because there was a highly instructive story before the opening bell today. At 7 a.m. Eastern Time, Abbott reported their first quarter earnings. Now they actually beat revenue and profit expectations for the quarter.
Okay, good news.
But they lowered their full-year profit forecast. And the reason was highly specific. Integration costs stemming from their recent acquisition of Exact Sciences. The market response to this was brutal. Shares of Abbott tumbled 3.2% today, and it acted as an anchor on the broader healthcare sector.
See, what happened to Abbott is actually a perfect demonstration of standard macroeconomic theory at work. The market is a forward-looking mechanism. The Q1 earnings beat is already historical data.
Right.
When Abbott lowered their forward guidance due to margin pressures and the friction of integration, the market instantly recalibrated Abbott's intrinsic value. Using a discounted cash flow model, lower future profit margins mathematically equal a lower stock price today. The market ruthlessly punished the stock for that friction.
And this is exactly where the textbook fails the real-world investor, and we have to talk about the price versus intrinsic value disconnect. Do you honestly believe that the underlying true economic value of Abbott's entire global healthcare business magically dropped by 3.2% between breakfast and lunch today?
Well, I understand the skepticism, but you can't entirely fault the models here. When forward guidance drops, the mathematics of discounted cash flow require a lower valuation.
Yeah, sure.
But the algorithms are simply executing the math of reduced future capital.
They are executing the math of a temporary headache. Real-world business fundamentals move slowly. Yes, there are integration costs when you acquire a massive, complex company like Exact Sciences. Corporate mergers are messy.
Very messy.
But this stock drop is like demanding a 3% discount on a perfectly good $1 million home just because the seller's moving truck is temporarily blocking the driveway. It is short-term friction, not structural damage to the house.
That's a good analogy.
The intraday drop is driven by algorithmic stop-loss triggers and impatient institutional capital demanding immediate margin perfection. And to you, the listener, this is exactly where the hopeful edge lives.
Expanding on that hopeful edge, how does a listener actually apply that concept here?
Well, if markets were perfectly efficient calculators, there would be no opportunities to outperform. But because the market emotionally overreacts to short-term integration friction, because it punishes a long-term strategic acquisition for having a messy first quarter, it creates a mispriced asset. For a common-sense investor with a multi-year horizon, algorithmic panic isn't a threat. It's the exact feature that allows you to buy a great, fundamentally sound company on sale.
Ah, I see. So you are arguing that the market is hyper-focused on pricing the immediate pain of the acquisition while entirely ignoring the eventual long-term strategic payoff.
Yes.
It's a very practitioner-focused way to navigate corporate volatility. I'll give you that.
Precisely. And speaking of navigating volatility and ignoring pain, it is time for our closing bell joke of the day.
Let's hear it.
The S&P 500 and NASDAQ just hit all-time highs for the 5th day in a row, proving the only thing more stubbornly resilient than the tight U.S. labor market is a bull run ignoring the Fed's interest rate warnings. Abbott's stock might have tumbled today as they struggle to digest Exact Sciences, but the math for our portfolios is looking exactly right. Let's ring this closing bell and celebrate keeping these equity gains higher for longer.
Higher for longer indeed. But, the market mechanism never sleeps, and the narrative continues to evolve. Looking ahead, there are 5 critical items on the radar for the next 24 hours.
What's number 1?
Number 1. We need to watch for FOMC member Waller. He is scheduled to speak on U.S. monetary policy at 2 p.m. Eastern Daylight Time tomorrow. Given the highly coordinated chorus of hawkish Fed officials today, his specific stance on the 2% inflation goal will be heavily scrutinized by the bond market.
Yeah, any deviation from that higher for longer script will move yields instantly.
Exactly. Number 2, we are keeping a very close eye on weekend geopolitical developments. Specifically, we are looking for any concrete news regarding those delayed Middle East ceasefire talks and the actual physical shipping status of tankers navigating the Strait of Hormuz.
We need to see if the reality on the water matches the diplomatic rhetoric.
Right. Number 3, we have ongoing Q1 2026 U.S. corporate earnings. And after today's severe reaction to Abbott, institutional investors will have a laser focus on profit margins and forward guidance, especially regarding any friction tied to recent M&A integration.
Makes sense.
Number 4, the U.S. weekly Baker Hughes rig count release. This will give us vital physical clues for forward domestic energy production in light of the massive global oil swings we saw today.
Okay.
And finally, number 5, we need to monitor for potential shifts in global yield differentials. If more ECB officials come out commenting on Europe's falling energy prices and hinting at rate cuts, that monetary policy divergence with the U.S. Federal Reserve is going to accelerate rapidly.
Which brings us to a truly fascinating crossroads for global finance.
It does. And I want to leave you with a final, broader thought to chew on today. We are looking at a U.S. economy that is completely dominating the $635 billion AI CapEx cycle. It is driving incredible domestic growth and keeping labor markets incredibly tight.
Yeah.
But at the same exact time, we have the European Central Bank potentially diverging on interest rates because their energy prices are falling and their regional growth is lagging behind. If these two massive macro trends continue on their current trajectories, are we witnessing the permanent decoupling of U.S. equity valuations from the rest of the global economy? Will standard global economic models even apply if America is operating on a completely different technological and fiscal engine than its international peers?
That is the trillion-dollar question hanging over this entire market right now. Let us know in the comments if you think this week's tech rally can actually survive the Fed's higher for longer reality. We would love to hear your thoughts. Thanks for joining us, and we'll see you on the next deep dive.